Today, we're diving into a financial tool that, honestly, can completely change how you look at a company's success. It's called Economic Value Added, or EVA for short, and it's all about finding a company's true profit by peeling back the layers of typical accounting.
So let me start with a question for you. Is it possible for a company to splash headlines with millions of dollars in profit, while at the very same time it's secretly destroying the wealth of its owners? The answer, which is kind of shocking, is a resounding yes. And this is the exact problem, this hidden flaw in accounting that EVA was built to fix.
Okay, this table really gets to the core of it. On one side, you have accounting profit. That's the number everyone talks about. It subtracts the obvious stuff, right? Payroll, supplies, rent. But economic profit, which is what EVA is all about, it takes this one giant, crucial step further. It also subtracts the hidden cost of using the shareholders' own money. The return they could have gotten somewhere else. That invisible cost, well, that changes everything.
Think of it this way. When you give a company your money as an investor, it's not a gift. It's not a free loan. There is an implicit rent that the company needs to pay you for using it, and that rent comes in the form of returns. Traditional accounting, it just pretends that cost doesn't exist, but EVA puts that cost front and center, making it crystal clear that a company isn't truly profitable until it has paid for all its capital.
So here's our game plan. We'll start with the profit illusion. Then we'll break down how to actually calculate economic value. After that, we'll check out the value scorecard to see what the numbers mean, look at a huge real-world example, and finish up by talking about why EVA is an amazing tool, but not a golden rule for every situation.
All right, let's get into it. It's time to pop the hood and really look at the engine of what makes a company truly profitable, the EVA formula itself.
And here it is. Now, don't let the letters scare you, because at its heart, this formula is actually really simple and elegant. You start with a company's operating profit after taxes. That's NOPAT. Then, from that profit, you subtract something called a capital charge. And that charge is just the total money invested in the business multiplied by the average cost of that money, or the WACC. The takeaway here is so powerful. Profit is only real after you've paid the rent on the capital you used to make it.
So this whole process really breaks down into three pretty clear steps. First, we figure out NOPAT to get a really clean look at how the business is actually running. Second, we have to measure all the capital that's tied up in the business. And third, we figure out the WACC, which is just the minimum return that investors demand. It's the hurdle rate the company has to clear to create any value. Let's dig into why each of these pieces is so important. NOPA shows us pure operational efficiency, totally separate from how the company is financed. Invested capital, that's the total skin in the game from everyone, lenders and owners alike. And WACC? Well, WACC is the final boss. It's the opportunity cost that a company absolutely must beat to create any real lasting value.
Okay, so we have the formula, we can get a number, but what does that number actually tell us? Let's move on to the value scorecard and learn how to read the signals of a company's real performance. The best part about this is how simple it is to interpret. If EVA is positive, fantastic. The company is creating wealth. It's earning returns higher than what investors could get elsewhere for the same amount of risk. If EVA is zero, it's basically treading water. It's meeting expectations, but not creating any extra value. But if EVA is negative, that's the red flag. The company is actively destroying shareholder wealth, even if its income statement shows a nice, tidy profit.
And really, the goal isn't just to have one good year of positive EVA. It's about stringing them together year after year after year. And when a company does that consistently, the stock market takes notice and rewards it. This creates something called market value added, or MVA. Think of it as the premium the market is willing to pay over the sheer amount of cash that's been poured into the business. It is the ultimate report card. But wait a minute, how do you actually get managers to care about this stuff, to focus on long-term value instead of just hitting next quarter's numbers? Well, this is where EVA goes from just being a metric to being a whole management philosophy. And one of the coolest tools for this is something called the bonus bank.
Okay, check out the difference here. A traditional bonus, right? It's usually tied to some accounting number, and you get paid the whole thing at the end of the year. That can encourage some really short-sighted decisions. The EVA bonus bank, though, is a total game changer. Bonuses you earn from creating positive EVA go into your bank, but you don't get it all at once. If you destroy value the next year, that loss gets taken right out of your bank. This forces managers to think and act like owners. This all sounds fantastic in theory, right? But let's see how it actually plays out in the real world with one of the most famous business rivalries of all time. So picture this. It's the 1980s, and the cola wars are raging. Coca-Cola and PepsiCo are battling it out everywhere. But behind the scenes, they were making completely different bets on their future. Coca-Cola, under its legendary CEO Roberto Goizueta, went all in on Eve et Awe as its North Star.
So what did that actually look like? Well, Coca-Cola became obsessed with its core, super high-return business, selling syrup. It didn't take a lot of assets, it gushed cash, and it led to absolutely massive positive EVA. Pepsi, on the other hand, was chasing growth at all costs. It went on a shopping spree, diversifying into the super capital-intensive restaurant business, buying up KFC, Pizza Hut, the works. Sure, revenues went up, but those businesses tied up so much capital that they often failed to earn back their costs, which means they were destroying value. And the result? It was night and day. Coca-Cola created an unbelievable amount of wealth for its shareholders. And eventually, Pepsi just couldn't ignore the facts anymore. In 1997, it spun off its capital-hungry restaurant division to focus on its high-return snacks and beverage businesses. That EVA-driven pivot was a huge success, and it proved just how powerful this framework could be on the world's biggest stage. But here's the thing. As powerful as EVA is, it is not a magic wand. It's a tool. And like any tool, you've got to know its limits and when not to use it. So here's a balanced view. The advantages are huge, no doubt. It gives you a true picture of profitability, it aligns incentives perfectly, and it forces managers to be disciplined with capital. But it does have limitations. It can be complex to calculate, and in some cases, it can actually discourage smart investments that take a long time to pay off.
Let's just touch on a couple of really key limitations. First, any big, ambitious, long-term project is probably going to have a negative EVA in its early years, and if a manager's bonus is on the line, that might scare them away from making a great long-term bet. Second, it's not a great fit for a lot of modern tech or service companies, where the most valuable assets, like software code or a famous brand, don't even show up on a balance sheet. Plus, that WACC calculation always involves a few educated guesses, so there's always a little bit of subjectivity baked in.
But even with those limitations, we should never, ever lose sight of the core idea. This quote just nails it. It's a simple and powerful truth. At the end of the day, a business has to earn more than its capital costs. Period. That's the only way it can be called truly successful.
And that's really the gift that EVA gives you. It's a brand new lens. So the next time you see a company bragging about its record profits, I want you to stop and ask yourself the most important question. Is that profit real, or is it just a clever accounting illusion? Are they actually creating wealth, or are they just burning through it?